BHP reports a big fall in profit and says it wants to offload its coal mines. The Reserve Bank thought about lifting rates 50 basis points 2 weeks ago, fearing that inflation might remain persistently high, and the incredible inside story of Joe Biden's sneak visit to Ukraine. It's Wednesday, the 22nd of February, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, you've got a fantastic interview today with a very well-known Australian Olympic champion, Grant Hackett, who is now Chief Executive of Generation Life, which is a business focusing on investment bonds.
It's a very nice fella, Grant. We talk about everything from being an Olympic sports person to having his private life played out very publicly, through to his job now as Chief Executive of Generation Life. And we sort of get into Generation Life provides investment bonds and annuities. It's a life company, and we talk all about the superannuation system and how people should think about saving for retirement. So very wide-ranging interview, this one. Well worth a listen.
Yeah, it sure is. The main story this morning, though, Sean, is a big one as well. BHP has reported a 30% slide in half-year profit and will offload more of its Australian coking mines.
The $9.5 billion profit was lower than expected, and the dividend paid is well down on last year's exceptionally large payout. While the fall in profit is large, 12 months ago, the big Australian was in the middle of boom times with much higher coal and iron ore prices. As they've come back, so too has BHP's profit. Iron ore remains the company's biggest earner, and export volumes, rather than value, were actually higher for the 6 months to the end of December. Profit margins were crimped by higher unit costs across the business. Now, BHP said demand from China and India has increased its confidence in its outlook. BHP's share price ended the day down slightly to $48.34.
Sean, BHP seems to be pretty keen to get rid of some of its, I suppose, so-called dirty assets.
Yes, the sale of its share of 2 coal mines in Queensland is part of the company's efforts to pivot towards future-facing commodities with a lower carbon footprint. BHP said the sales were about recognising that it only wanted to operate mines producing top-quality coking coal, which actually emit less carbon. Now, last year, BHP sold 2 other coal mines in Queensland. Even more interesting, though, Michael, are the media reports around Chief Executive Mike Henry's commentary. He said governments around the world are touting for investment in their countries, particularly in green energy minerals. Now, given BHP is the biggest miner in the world, Henry's dance card with national leaders is pretty full. In fact, he went on an 8-week sojourn recently, and he said he couldn't fit in all the meetings with leaders of countries. He said governments are providing big incentives to entice green mining. The biggest thing is the Inflation Reduction Act in the US that provides plenty of subsidies for miners. But Henry said Canada's doing it, so too many Asian nations. The inference in all this, of course, is that the Australian government needs a stable, friendly environment to attract investment. If you think about the Queensland government recently pushing up royalty payments on coal, that's an example of a not-so-friendly government. So I think the point that Henry was making is that the federal and state governments in Australia need some certainty and an investment-friendly environment if they expect big miners like BHP to invest.
It's a really interesting story, Sean. The highlight for me, though, was the reference to Mike Henry's dance card, which is really one of those references to something that I reckon dance cards might have even just predated you just a little bit, your youth, and
maybe
heading off to balls at the local manor, that kind of thing, and putting down your name for a waltz. I'm assuming these are all my assumptions based on your childhood.
Do you know what a dance card is?
Isn't it one of those ones that like on Bridgerton and other...
Yes, that's exactly, yeah.
Yeah, where you kind of put your name down for your
opportunity at a formal dance to find an esquire to perhaps dance with you.
And have you ever been to one where a dance card is actually used?
No, but wouldn't it be cool? What happens if no one actually put your name on it?
You go home.
So you
just disappear. I'm pretty sure that kind of thing still happens.
How did we get here from BHP, Michael? You had this incredible ability to take a very serious story and just find a little bit of a left turn in it.
That's my gift here. It's what I bring to this podcast.
Thank you.
I don't bring much, but that's what I bring. Sean, how did local markets perform yesterday?
Look, the S&P ASX 200 finished the day down just a touch to 7,336 points. The bourse tumbled in early trading and then spent most of the day climbing back to close to where it began. Again, it was all about earnings results. We'll go into some of those in a moment. The banks were generally lower. Fortescue Metals jumped 3%. Rio was up nearly 1%. South32 rose a couple of percent. Wesfarmers, Telstra and Goodman Group were all sold off. Just very briefly, a few earnings. Online recruitment company Seek share price fell after it said full-year profit will be at the bottom end of its forecast range. Basically, job ad volumes are coming off the boil, which is interesting in an economic sense. Similarly, ARB Corporation, which supplies auto parts, it said its profit was down 30%. Economic uncertainty is part of the problem for that. The worst on the day was the housing group Ingenia Communities. Its share price fell as much as 20% before finishing down 30%. After it downgraded its full-year guidance. Other end of the spectrum, builder Johns Lyng delivered strong profit growth and upgraded its earnings guidance. Its share price jumped 13%. Just interesting that a builder is doing so well.
Yeah, and what about international markets? What's happening?
Oil and gold prices are off a bit, so too coal. Iron ore futures are higher. In fact, they're back around the levels seen in June last year. And the Aussie dollar, Michael, is trading around 69 US cents.
All right. We'll be back in a moment with the rest of the day's business news. Sean, the minutes of the Reserve Bank February board meeting 2 weeks ago show that there was never a chance of rates remaining on hold. And in fact, a 50 basis point increase was actually discussed.
Yes, I don't know if you remember a couple of weeks ago, Michael, but there was talk that there wouldn't be, that the Reserve Bank should pause. It was quite the opposite. Now, in the end, we got a 25 basis point increase, and commentary from the bank since then suggests another couple of rate rises are in the offing. So much for that whole idea of pausing that many market watchers thought was likely. The minutes say that recent data suggest more breadth and persistence in inflation than had been expected, and stronger demand was leading to price increases in some parts of the economy. Now, while inflation is expected to fall, there's a risk that it could persist at uncomfortably high levels, and that would have long-term consequences. What we've heard from Governor Philip Lowe since the board meeting is that persistently higher inflation would have much worse longer-term consequences, like a recession and unemployment, maybe at 9%. So higher rates are still needed. I think the news out of yesterday was people, again, were slightly surprised at just how determined the Reserve Bank is to lift interest rates.
Sean, considering a lot of market watchers thought that perhaps there might have been a pause in increases, would the Reserve Bank have taken into account that kind of commentary in deciding whether to go with 25 or 50 basis points? Because assuming that if people were expecting perhaps no rate rise, to go the other way and have 50 basis points would have been kind of sent out a few shockwaves.
Yeah, I think what they're really trying to keep a cap on, and this is thanks to a column by Ross Gittins in the past couple of days. He's the economics writer for the Sydney Morning Herald and The Age. Ross reckons that the Reserve Bank is trying to keep a cap on inflation expectations. The thing is, if you think prices are going to rise and you're running a business, then you'll start charging your customers more. If you're a worker and you're looking for a pay rise and you think everything's going up 10%, you want a 10% pay rise. So it's this whole inflation expectations which the bank is trying to cap, really. And so the Reserve Bank, it's in their interest, I suspect, or at least they believe it's in their interest, to talk about inflation and the need for higher interest rates just to cut off those inflation expectations, more so than inflation itself, because inflation has probably peaked, but the Reserve Bank does not want people thinking that prices are going to remain high for a long time. And that's probably as important in its actions at the moment as actual rate rises.
Oh, that makes a lot of sense. Now, Sean, this is a great story. Supermarket giant Coles will get a female CEO, the first in its 100-year history.
Yes, Leah Weckett will take the top job on 1 May, replacing Stephen Kane, who will retire. Ms. Weckett has worked across the business since 2011. Her CV is great. It's sort of pretty much all the parts of the business you want someone to know about. So she's been Chief Financial Officer. She's run people and culture. We used to call that human resources, nowadays people and culture. She was the State General Manager at the Victorian supermarkets. More recently, she's been acting head of commercial and express. That's a pretty solid resume, Michael.
And it sounds like good succession planning then.
Yeah, absolutely. The Adelaide native has a background in engineering, science and business. She spent the early part of her career at McKinsey & Co., the consulting firm. Now, the appointment came yesterday as Coles posted an 11% jump in its bottom line, made $616 million for the December half. That was pretty much because price inflation boosted sales in its supermarket. The group also upped its interim dividend. Coles said prices of fresh food and dry goods continue to rise. That will put pressure on households, of course. The good news is that supplier cost inflation looks to have peaked. Coles' share price closed down 1% to $18.09.
Sean, the boss of the Australian energy market operator, says businesses and homes across Australia are at risk of electricity shortages from 2027.
Yes, Daniel Westerman told ABC Radio yesterday morning that he expects increasing reliability gaps towards the end of the 2020s as coal-fired power stations close, and those gaps will hit all states in the national electricity market. Investment is urgently needed, he says, in long-duration energy storage, generation and transmission to mitigate against these shortages. Now, the worst hit states from 2025 will be New South Wales and Victoria, but it will spread across the whole market. That means South Australia, Queensland and the ACT will be hit as well. Prime Minister Anthony Albanese acknowledged the report yesterday. He blamed a lack of investment in renewables under the previous government. He was speaking ahead of the federal cabinet meeting in Pilbara yesterday. Mr Albanese announced a $565 million spend to upgrade port infrastructure in the region in an effort to boost trade. And just before we leave, Anthony Albanese, yesterday he said the referendum on the Indigenous voice to Parliament will be held in the final 3 months of this year, Michael.
All right, this is an interesting one, Sean. Australian organisations deemed as running infrastructure critical to the country's national interest will have to increase their investment in cybersecurity protection to comply with new national security requirements, and the measures are estimated to cost companies almost $10 billion.
Yes, this one's gone under the radar. A new risk management protocol signed off by Minister for Home Affairs and Cybersecurity Claire O'Neil will make board members culpable for failure to properly secure assets and will cover companies across sectors including energy, healthcare, water, food, transport, communications. As part of consultations, according to the Financial Review, affected companies in various sectors provided cost impact statements which calculated the impost on businesses would be more than $9 billion over 10 years. Mind you, these costs are far less than what's projected if they suffer service outages.
Sean, Tabcorp's share price jumped 4% yesterday after the wagering group announced a return to profit and said it was undergoing a major cost-cutting initiative.
The wagering business wants to use any excess cash to reinvest in growth strategies, particularly its digital gambling strategy. That one is working for the group. Remember in May last year, Tabcorp spun off its lottery division. That's now called the Lottery Corp. That was actually the moneymaker for Tabcorp. So Tabcorp's future now really is about digital gaming. It still has 300 TAB stores and in-venue offerings in like pubs, clubs, racetracks, that sort of thing. But it's really all about online gaming. Now, in the final 6 months of last year, following the release of a new betting app, Tabcorp maintained its market share. That's the first time in about 3 years that it had done that. So some good news for that company.
Viva Energy's share price fell as much as 6% yesterday before closing down 3% after the group reported a lower than expected profit despite also recording record revenue.
We talked about Ampol's cracking result yesterday. Well, Viva's profit for the final 6 months of last year was still up more than 200%. Still pretty good, but higher costs hurt the bottom line. The result just wasn't as good as analysts expected. Boss Scott Wyatt said the result was outstanding with all parts of the business performing well. You know, Michael, sometimes when you read CEO statements, it really depends on the personality. But in this instance, Viva Energy's CEO, very effusive in his judgment of the company. Then you see other ones and they're not quite downbeat, but they're very realistic. Shall we put it that way?
So you need to assess the personality as well. Because there's so much you have to look at, isn't there?
Oh, so much. Anyway, Scott White, the boss, said recent federal government intervention and an easing of global supply bottlenecks had improved Viva's cost outlook.
Sean, one more result worth discussing. Property giant Stockland reported a big fall in net profit after parts of its portfolio were revalued and cut the number of apartments it expects to settle.
Yeah, there are so many property companies on the ASX. We don't talk a lot about them, but Stockland's one that we all know. It has malls, we know that, but it's also lots of residential apartments. It now thinks it will settle 5,500 lots this financial year. It only settled about 1,800 in the December half. It thought it was going to do about twice that amount, but a lot of poor weather has really gotten in the way. Chief Executive Taran Gupta said sales had picked up in the final 3 months of 2022 and inquiry levels are up sharply this year. Still, Stockland's share price fell 3.5% yesterday.
And finally, Sean, before we get to international news, anyone that has kids and has recently tried to buy a house near a primary school will not be surprised by this next story.
No, houses within public school catchment areas have vastly outperformed their respective suburbs in the past year. In fact, values in some cases are rising 10 times faster than other areas, according to Domain's School Zone report. Now, buyers are willing to pay a premium to make sure their kids attend the schools they want them to. The report lists a number of growth zones, with the area around Artarmon Public, that's on Sydney's North Shore, experiencing the strongest growth, all up nearly 44% last year. Remember, Sydney house prices went down, 11 or 12% last year? Not near Artarmon Public. Highest in Melbourne was the area around Alphington Primary, where median house price growth last year was 28%. In Brisbane, it was the area around Walloon State. In Adelaide, around Carrara Public, that's in Morphettville. And in Western Australia, around Davalia Primary, which is in Duncraig.
All right, Sean, on to international news. And this is just a cracker. The story of how Joe Biden, the US president, snuck into Ukraine to meet Volodymyr Zelensky is just straight out of a spy novel.
Yes, Michael, it's pretty good. The presidential motorcade left the White House about 3:30 a.m. He didn't take Air Force One. Instead, it was a smaller modified Boeing 757. He landed in Poland and then took an overnight train to downtown Kiev. 20-hour journey all up. Now, videos on social media show Biden walking with Zelensky in Kiev's St. Michael's Square as air raid sirens blare in the background. The US president laid a wreath at a memorial to fallen Ukrainian soldiers. 5 hours later, he jumped on the train back to Poland. Now, it's the first time in modern history a US leader has visited a war zone apart from militarized areas. The only person who did know about it, the only global leader who did know about it, was Vladimir Putin, president of Russia. Presumably, they told him because they didn't think that Russia would do anything too stupid while Biden was there.
Yeah, because they'd all be expecting, they would have seen a few kind of world leaders coming through and expecting it to be like, oh, the Australian Prime Minister's here. Oh my God, it's the US president.
Yeah, pretty cool.
Especially when he does it all. Have you seen with the pictures? He does it all wearing his aviators.
Yes.
He looks very cool, doesn't he?
He does. For an 80-year-old, he's certainly got style.
Yeah, he sure does. Finally, Sean, the combined equity market value of Adani Group's 10 companies slipped below $100 billion yesterday as the embattled conglomerate struggles to reassure investors following a scathing report by a US short seller.
Yes, the Ports to Power Group has now lost more than $136 billion in market capitalisation since January 24. According to Bloomberg, that's when US-based Hindenburg Research published a report alleging accounting fraud and stock manipulation, accusations that Adani Group has denied repeatedly. Billionaire Gautam Adani and his companies have hired legal and communication teams, cut expenses and repaid debt as they seek to calm traders concerned about the group's access to financing. Now, while a campaign brought the conglomerate's dollar bonds back from distressed territory, it certainly hasn't stopped the stock sell-off.
No. All right. Up next is the Fear and Greed daily interview with Grant Hackett, Olympic champion, now chief executive of Generation Life, talking all about investment bonds and superannuation and everything really, Sean.
Yeah, it's just a great chat about, being Olympian, his personal life being very public and what we need to do in the superannuation industry.
It is a great chat. It is worth a listen. It's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Also worth a listen today is the new episode of How Do They Afford That? It comes out every Wednesday. It's our sister podcast, really focused on making your money work a little bit harder for you. This week's episode is a little bit different, though. It's all about resilience. Basically, when you keep taking hits and your money just keeps disappearing from one thing after another, how you just keep on going. It's some really good advice from Canna Campbell, a co-host on that one. Thank you very much, Sean.
Thank you, Michael.
It's Wednesday, the 22nd of February, 2023. Make sure you're following the podcast and join us online on LinkedIn, on Instagram, Twitter, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.